So welcome to August's property market update, and in this month's edition what we're going to be covering is the house prices and the rent prices. We're going to be covering a bit about building and materials. We're going to be covering a little bit around just the different lenders that are coming back into the market, starting to flood into the market at the moment, touch on a little bit of inflation, and at the end make sure you stay to the end because we're going to be touching on whether or not now is the right time to invest in property, and I'm going to give you my opinion and my thoughts around this. But if you're new to this channel, make sure you hit that subscribe button, make sure you hit that share, and put it in the comments any suggestions you have, and the bell icon so you get these notifications up all the time. I want to say a massive thank you to everybody on last month's edition of this. I'm going to do it again because ultimately I've got fantastic views and comparable to the size of my channel, and I want to say a massive thank you for all the people starting to follow us, subscribe and share this stuff out. So please share that, keep on sharing. So this is where I bring to you all the information I accumulate after following some people, a couple of new people on the list, the anxious investors on there, but I follow Rick Gallen all month and he's my TikTok buddy. Ranjan, Your First Four Homes from Tony Law. I accumulate loads of information from other people on their monthly reports, the Rob and Rob from the Property Hub, and I'll bring it to you with the information I picked up myself and my views around that. So come here every month. I'm going to accumulate everybody's views in one place. There's a few others on the list, so sorry if I missed anybody, but this is where we're going to bring you in one place with my views each month. My mission is to live on my own terms. My mission, my business, and my one-line mission statement is to help as many people live on their own terms via property as possible. So let's share this message. Let's make sure as many people get this out there so you can live on your terms using property as a vehicle to get that. So first of all, what are we going to talk about? We're going to talk about the housing market and the prices. It has been absolutely bonkers. The market has been crazy. It's been an absolute seller's market, apart from if you're in central London. Surprisingly, central London is doing the worst than any other region in the UK. And all the forecasts going forward, Savills and all the big players forecast is forecasting London to stay at the bottom. Even the North East, that hasn't climbed at all since the last recession, climbed more in the last 6 months in the last year than central London did. Some of the home counties are propping it up a little bit, but there's that ripple effect. And why is this happening? It's because of the price per earnings ratio in London. It's now on average 18 times the average salary. That said, there was a few big, like I think, was it Savills? There was a report showing that a few bigger players have come back into the central London and the 5 million plus market, but they didn't report on the prices and if there's any growth. And the fact they didn't report on that kind of indicates that there probably hasn't been any growth or any price jump up. But areas leading the way with this price growth has been the Northwest and Wales, and as I said, even the Northeast has been absolutely flying. And in my opinion, as I'm saying, it's because of the affordability and the infrastructure going into these areas. Now there's infrastructure, there's training that's going in, there's major employers turn up in these areas. This is massively forcing up these areas in line with wages though, where London got massively over bubble when there was 110% lending, there was overseas investment there, and all the only jobs was in London. Now they're spreading out and the infrastructure's coming. You can see this really evening up. But with that said, there is signs of it starting to cool. But I'll say starting to cool. It's still growing. Demand is outweighing the supply at the moment, and the simple economics tells you that is what's going to push a market upwards. You don't need to be an economic whiz kid to understand that, but it is showing signs of slowing down. So Rightmove on all these platforms are reporting data of the percentage of growth is slowing. So it's still growing, but the percentage is slowing. And obviously we're coming to the end of the stamp duty. We're coming to the end of the planned furlough that don't get extended, and the economy is opening back up. And also we're in summer holiday months, which is notoriously slow for the property market. But again, when you look at the global market, this is not just happening in England. Like, the whole world has been on that finger on the printing press. The whole world has been pushing forward the quantitative easing, which is creating money and pushing it into the economies. And the whole world has had a massive spike in the real estate and property markets. And I say real estate because I'm talking about America. America in some states has had 23% growth in a year. So if you quantify this in pretty much 4 to 5 years time, their property price is going to double, which is absolutely phenomenal. Can this keep on going on? My opinion is no. The reason London didn't do the same as the rest of the regions in the UK is because of that price per earnings ratio. And you're always pushing towards that. I think London is still that ripple effect. Like usually what happens in central London ripples out to everywhere else in the country. And I feel that's going to happen everywhere else in the country, but it's going to take a lot more time to catch up before the price per earnings ratios so wide in these other areas. Hence why in some of these northern locations, why I Remote Property Invest, it could be the last opportunity to get single let buy-to-let properties as vanilla single let buy RR strategy. I think the next maybe decade will show the last opportunity of that, because the prices will go up and the rents won't keep with that, and that strategy will be dead. And the only strategy you could do after that will be really bigger development stuffs and more creative stuff like service accommodation and HMOs. Let's touch on the materials and the building element. One of the things I think a lot of people are overlooking is the demand on builders is tough at the moment. I've got a 4-bedroom flat conversion, was kind of a HMO slash flat conversion, which will turn into an apart hotel to let out and service accommodation. 2 weeks before completion, I had a builder lined up at the start. It was an 8-week completion on auction. 2 weeks beforehand, the builders pulled out, and I'm scrambling around trying to get trades. So trades are double booked in, but materials are really going up in price, like rapidly. Every job and every refurb we're doing at the moment, we could see that incremental increase upwards, and this is inflation pushing things up. We'll touch on inflation again a little bit in a minute, but this is just pushing things up. So price of timber is up around 120% at the moment. That's phenomenal. And the forecast for all sort of materials is forecast about 10% rise. We're just not manufacturing it quick enough, getting it into the country quick enough. Like with Brexit, with the lockdown, with manufacturers shutting down, there's a massive backlog of that. But that said, I have heard in one report that Russia is out chopping down lots and lots of forests to try and replenish this timber shortage. And that said, when it does replenish, it'll be a supply and demand. Prices might creep back down, but it might stay at a new base level. So make sure when you're doing your refurbs, when you're doing your estimate costs, make sure you factor in the jump up in price of not just the timber, but also the labour element to that, because the more the builders in demand, the more they put their prices up. Plasterer, I was talking to the other day on a job, I used to get him for 110, he's now 140. So that's quite a significant percentage of a jump up. One of the other things that's pushing this housing market, everybody says it's a stamp duty. There's lots of elements at play that this market is really growing at the moment. It's not just a stamp duty. It's not just the bounce back loans and the C-balls. There's loads of things that's accumulating this and coming together. And one of the big things is the shortage of stock. Stockpiles down at like all-time lows, like 225,000 houses for the rental and for the purchasing sort of side of it are lower than Rightmove are predicting at the moment. This is massively keep pushing pushing a pressure on the property market at the moment. But also what's happening as well is lenders have now got their appetite back. So last year when COVID first hit, loads of lenders pulled their products out of the market. And one of the signs of this, TMW is one of the biggest buy-to-let lenders out there. They've just brought back their 80% loan-to-value product. It's only for energy efficient homes, and it's got to be a C rating and above. But they brought this back into the market, which is a massive shift to show you the appetite towards lenders, from lenders. And now there's more and more products coming out. Now more and more lenders feel a bit more comfortable in this space. Obviously, that more lending and more availability of lending also puts a pressure upwards on the prices. So the pressure is not just the fact that the stamp duty happened and the stamp duty holiday happened. It's a load of things. It's stockpiles, I think, is largely behind it. But obviously, with uncertainty in the economy, money tends to drift towards asset prices, inflation. Also, the fact that there's so many accidental savers. So over the last year, there's so many people that couldn't go to restaurants, couldn't go on holiday. A lot of people didn't even commute. Like my wife alone, I think she was saving around £500 or £600 a month just on commuting costs. You got to think that's significant. If there's two people in a home working together and saving that and not going out and not putting fuel in their car, lots of people got a lot more money in their pocket to spend on property. And leading into that, let's talk about inflation. So inflation has now hit 2.4%. That's up from 2.1% and above the 2% long-term target of the government. So one of the consequences of pushing so much money into the economy is inflation can go up, because obviously when there's a lot of money people are spending, this pushes up the demand on things. When the demand gets pushed up and the supply goes down, people just naturally put their prices up, and that's what creates inflation. So one of the dangerous things of producing and printing, I say printing, you don't print anymore, it's quantitative easy, just press a button on the computer and it creates another zero in a digital file to say there's more money. But the danger of that, the more you put it into the system, the more dangers there is of creating hyperinflation. If you just look back at Germany in just after World War I, they printed tons of money to get out of World War I and collapse their economy. Look at countries like Zimbabwe at the moment, and some of the South American countries are really struggling with hyperinflation. And America's already creeping even higher than that. So that usually what happens in America in the financial terms, because they're the reserve currency, that actually ripples around the world and affects all the sort of, especially the Western world. So definitely something to keep your eye on. But one thing with inflation and one thing to remember is it can be your friend. Government government do not want to massively spike the interest rate at the moment because they've got loads of lending. The lending levels are higher than they've ever been since, I think, 1961 and definitely World War II. And it's above the GDP. And one of the things that inflation does when you've got big debt is it shrinks your debt, because if you have a debt here, which is, say, for £10,000, say £10,000 in 1996, that would have been enough money for a deposit on a property in central London. Today, that same £10,000 won't give you a deposit for a garage in London. You would need more like £100,000. So this is inflation. So your money, as your wages slowly goes up and all the prices of goods go up, it's not that the prices of the assets are generally always going up. It's inflation's pushing things up. But the thing is, your debt stays exactly where it's at. So you could imagine in the 1980s, the average property was 15k in London, but the average wage was around 6k. So 15k was still a lot of money back then. But today, if somebody got a loan on that and even had interest only, that 15k is not even like is a lot less than a year's wages for many. So inflation will shrink your debts in the properties that you own. So if you use leverage and use debt to buy properties, inflation could be your friend to shrink that. So it's not such a bad thing, but you've got to keep an eye on it and keep an eye on the interest rate possibility, rises of the interest rates that could come as a result of it going out of control and hyperinflation, because it's usually one of the levers the government use or the central bank policy makers use to slow that down is interest rate rises. But I'm not sure they can push it too hard. One, the debt of the government. Two, the household debt ratio is larger than it's ever been. And we're kind of in an experiment. We can look at the past to try and predict what's going forward, but we've never been in the same situation as today, and especially at a point of transformation and change with technology going into this tech revolution. And the final one you've been waiting for. Before we get into that, please give us a like, please give us a subscribe if you find this useful. My mission is to make as many people live on their own terms through financial education as possible, so share this out to the masses. What we're going to talk about is, should you be buying now? So the property market's massively raising, it's hard to get deals. I mean, it's all from my mentees all the time. So some of my mentees are saying, should I sit on my hands, should I wait? And the answer is simply no. I've got 4 deals as time of recording this in legals. One is a development of service accommodation for apartments, one is a HMO, and 2 are the single let properties. There is still deals out there, but it's harder. But one of the things you will get from consistently being out at the moment is one thing that's more valuable than deals is your network and your connections. And if you sit on your hands and do nothing, no matter how good your network is, them connections will slowly, out of mind, out of sight, out of mind, should I say, they will slowly diminish them networks and connections. So keeping that rapport with the agents, and the deals like the HMO I just got literally come to me before I hit the market, and that's the best chance of getting these deals. The reason it comes to me before I hit the market is because I had a rapport with the agent. So you've got to make sure the relationships and rapport you'll build with agents and direct to vendor stuff will pay you massive dividends going forward. Either the chance of getting the odd property. So at the moment, I would like to have 8 deals in legals. We've got the capacity to do that. We've got the team around us to do that, but we just can't find the deals. But it's better to have 4 than 0. Also, I'm making sure I'm forcing up the cash flows in some of these. So some HMOs, some service accommodation. So I could potentially look at commercial values on some of these as opposed to just the normal deals. So you've got to think a little bit more creatively, but what you want to do is invest for cash flow. If you've got strong cash flow that can handle any asset price fluctuation. So for example, if you've got 75% loan to value on this and you're lending like it was 100k and you've got lending of 75k and it drops to 90k, you might not get another 75% loan to value loan on that. So you've got to look, if it dropped and you was in a variable rate, how could I afford the mortgage and where would that be? Say the rates rise, where would that be? So stress test them at 5, 6, 7%, depending on your level of risk appetite. Again, this is why I remote property invest, because you can't buy single let properties in and around London and the south that produce 7, 8, 9% yields and that can survive these really like strong survive these spikes in interest rates. I don't think we're gonna get a massive one, but you want to be safe with that. And the main thing you want to be safe on is if we do get a dip, if it's over bubbled and overinflated now, it's going to go on a variable rate. And so look where that interest rate would sit at a variable rate, so that you know that your property can still make a profit, or at least bare minimum wipe its face for the long term. But investing should be a long-term gain. Invest for cash flow. Cash flow is king. Like flips at the moment is going to be a bit more tougher because of the margins in them, and also you don't know if the market will turn. But in my opinion, we've got a while to go until this thing start calling off. If you look at the 18-year property cycle, it looks like we're at the start of this rapid growth thing, and it's playing out just kind of textbook by your clock. But my advice is do not sit on your hands, still be out there building your networks, building your credibility, documenting what you're doing. What you're gaining, that will be an asset in itself. The networks and the connections you'll have will be an asset, and you documenting your journey and your social media profile will also be an asset. So if you get deals done in the middle, fantastic. If you don't, people will see how consistent you are. So when the deals do come through, you'll be the first person fresh on their mind as investors and as in people that send them, either agents or direct to vendors. So keep yourself out there. I know it's tough at the moment, but keep going, keep doing what you're doing, and things will happen. As I said, please give it a share, please give it a like, a thumbs up, really helps the algorithms on here. And remember, if you don't evolve your ideas, you'll never live on your own terms. So evolve your ideas, live on your own terms. Have a great day.